What's good, everybody? Welcome to the Hunk and Cash Club. I hope your day started with money. I'm sorry for not uploading for so long. I actually moved and I've been a little bit sick. Let's get right into it with Bristol Myers Squibb. They haven't been doing too well recently, with year to date down 17%, and it's not looking great over the last 5 years either. But right now they are trading at a 15.2% free cash flow yield and 5.2% dividend, which obviously is well covered. So it might be a really compelling case building up here. And what about their performance? Well, Q2 saw them having quite flat year-over-year sales. They expect around 47 billion in revenue for this year compared to last year's 48.3 billion. This would mean a 2.7% decline. Non-gas EPS of around 6.5, which means they're trading at a forward PE of around 7.2. Quite cheap, but that's to be expected for a company expected to decline. And I actually used to own this company. I bought it back in 2024 at 44 and sold at 52 when some covered calls I sold got triggered. And I'm seeing potential to do something similar right now, but I'll show a practical example a little bit later in the video. Now, as I mentioned, dividend is well covered. You can see cash flow here in gray, around 14.6 billion for last year, while the dividend payments were just under 5 billion. So they can pay it quite easily, even though it's quite a high yield, and that's good. Now, here in pink, I want to show this as well, because this is actually one of my problems with the company. They make a lot of acquisitions, and they've been doing it for a long while, and they kind of have to keep doing this. And this is because two of their drugs are about half of the revenue. It just so happens that the patent expirations are around 2028 for Opdivo, one of them, and then Eliquis, another one, also 2028. The patents are expiring, we can expect generic drugs to come on the market, and this could really eat up some of the revenue. So they know this, and that's why they are acquiring a lot. And they actually separate their revenue into the growth and the legacy portfolio. Yeah, they're quite similar now. You can see the growth portfolio obviously grew a lot, 18% year over year, while the legacy portfolio declined about the same in the dollar amounts. But as you can see, I've highlighted two drugs in the growth portfolio, and they're the Opdivo ones, which actually was the one of them from last slide, which have the patent expiring, and the other one was Eliquis. So I don't know about them in the growth portfolio. Yeah, they might grow, but until 2028. But anyways, they do have good growth in the growth portfolio. Of course, it's gonna be due to acquisitions, but still, I mean, it's not a dying company. They're sort of changing their product portfolio right now. According to Traxon, they made acquisitions almost every year, and some years even more. And let's see if this continues. If they continuously have to acquire businesses just to sort of stay even, because I mean, I think they're gonna move products from the growth portfolio to the legacy portfolio when they not longer grow, and then they start to decline, and the legacy portfolio just can sort of keep declining while the growth portfolio can keep growing, but they always cancel each other out. And if they have to make a lot of acquisitions all the time, then what's the point of having a high free cash flow if all of it's sort of going into maintaining the same revenue? But I'm no expert, but this is just my thoughts. But what do they themselves see about their capital allocation? Well, first of all, you can see the cash flow from operations, and yeah, it looks really good. And as the first point, they do have business development for the long-term outlook, so basically M&A. And then balance sheet strength, on track to pay down 10 billion of debt by the end of Q2 2026. And yeah, you can see they have a lot of debt. Actually, a lot of it they raised in 2024 when they made an acquisition. So I don't know if it's actually going to be permanently paid down or if it's just paid down in order to make another acquisition a little bit later. And then also, of course, the dividend, which I don't think they're going to cut. And they have 5 billion of share repurchase authorization remaining, which they might use, but I saw that they haven't bought back any stock since 2023. So I'm not sure if they are going to buy back much stock right now. So I want to get into the valuation, but first I want to show a small slide like this, because as I said, I'm no expert and I think there are good upsides but also major risks, and I want you to decide yourself if you even want to believe my valuation, because the assumptions in the valuation of course rely on the upsides and major risks playing out in a certain way, which I could not know. But anyways, for the upsides, of course, the low valuation, the growth portfolio that keeps growing at a nice rate that might make the whole company continue growing, and then the well covered high dividend yield. If interest rates drop, then that would be good for the debt also, but usually dividend stocks rise in that sort of environment. And of course also the multiple reversion potential. I don't think this is going to trade at 15% free cash flow yield forever if the fundamentals improve. And then for the major risks, well, the patent expiration, we really don't know how the revenue is going to look after that or what's going to happen. Then also the US political landscape, where the president has now talked quite a bit about the drug prices, and in general, I haven't read too much into this, so I think this is quite a big risk, at least for my part, with my level of due diligence here. And then always with medical companies, there can be lawsuits or other surprises that are really hard to predict as well. And then what we talked about, endlessly acquiring just to keep up. If this happens, then what's the point of a 15% free cash flow yield if you can only see 5% of it? So for the valuation then, with the risks and opportunities in mind, I actually made two valuation sheets. And the first one, indicated by the green, is the bullish case scenario. So here I took their guidance for 2025 and I grew it a little bit with flattened expiration year. I had a similar free cash flow margin to what they've historically had, and a multiple of 11, and yeah, I mean with 5.5% of dividends, that would be just about a double in 5 years. So 7.2% CAGR, and you need to buy it around this price to get the double. And then for the bearish scenario, indicated by the red, I grew it a little bit and then I shrunk it by 5% after the expiration, which also could lead to a slight compression in the free cash flow margin, and probably the multiple wouldn't be that high then either. And I mean, even with the dividend and no buybacks, this would be a terrible scenario. But keep in mind also that both of these scenarios had 0% buybacks and a 5.5% dividend, which means this does not account for like the 9 billion of free cash flow that they actually make on top of the dividend each year. So this assumes that they can spend 9 billion on acquisitions every year and still achieve like these growth numbers. And in that way they are conservative, but I say it's up to you to decide. These are just some perspectives, and actually, as promised, I want to show you the example of selling covered calls on this stock. So this is from Interactive Brokers, and with Bristol Myers trading at $47.13, I looked at the options expiring 1 year from now, and I looked at the calls for the 55 strike price, and you can sell one for $2.34. And that actually counts out to around 5% yield in 1 year. And if you combine that with the dividend, that's around 5.2%, then you get a guaranteed 10% in yield if we don't count with the stock price decline or appreciation. And if the stock price would increase a lot to 55 or past 55, then that would count out with the options premium, dividend, and stock price appreciation to a maximum of around 27% upside. So I might do this, I might research a little bit more. If you have thoughts, please put them in the comments. I'd love to read it. I'll promise to respond to everyone. And yeah, thank you for watching and keep cashing.